what we're going to be going over here is production volume variances, and we're going to get an understanding of what those are. We're going to apply it to a problem here, and we're looking at it in terms of absorption costing. So what we're talking about with production volume variances, this is where it's going to affect our fixed overhead here that we're applying to our product. And just going through our absorption costing here, this is where we're going to start out. We're going to take all our factory costs, direct material, direct labor, and our fixed and variable overheads. Those are going to be our total manufacturing costs, and they're going to flow into our inventory accounts and up through our cost of goods sold here. And with absorption costing, what isn't included would be all those non-manufacturing costs, engineering, development, so forth, selling and administration costs. Those would be expense for the period here. They wouldn't be included in the cost of goods sold. But what we're going to look at for our production volume variance is based on the fixed overhead here. And that's where we're going to either under-allocate or over-allocate any fixed overhead we have for the period. And just to look at our cost flow, where we've taken all these manufacturing costs, those total manufacturing costs, they would flow into our inventory work in process account, and then you take your beginning work in process, add to it all those total manufacturing costs for the period, and then you'd have to subtract any ending work in process balance that you have. That's going to give you your cost of goods manufactured. And then for your inventory for your finished goods here, all you do is take your beginning finished goods, add to it all the cost of goods manufactured for the period, and then you'd have to subtract out any ending finished goods. So in your finished goods here, you're going to either have either your beginning amount is going to be greater than your ending amount, or vice versa here. But nonetheless, whatever you have here in your finished goods that you actually sold for the period, they're going to go into your cost of goods sold account here, and they're going to be expensed here. Everything up through this point has been an asset, but whatever you sell is your cost of goods sold for whatever you sell here is going to be expensed against your sales for the period. Okay, again, so what we're looking at here, just looking at it in terms of our income statement here, well, for absorption costing, our direct materials, beginning amount, what you purchased for the period less your ending amount here equals your direct materials that you've used for the period, and then your manufacturing costs. That would be the direct materials you have used here for the period, plus the direct labor, plus the variable and fixed overhead here. And this is where we're going to get that production volume variance with this fixed overhead. That's going to equal your total manufacturing costs. They flow into for your cost of goods manufactured, just again, total manufacturing cost, and then you'd beginning work in process, add to it less the ending work in process, so you're going to get a cost of goods sold, and so on here. We would get down to the point here where we're going to take those. Okay, we'll get down to the point here where you have to determine some operating income. All right, so what we'll go on here and we're going to look at this fixed overhead here and how we can allocate that fixed overhead here for our production that we produce here for the period here. And that's what we're going to be looking at for our volume variances. All right, so going down here, when we're talking about this fixed overhead allocation, really this is where you're going to take your total fixed cost here for the period, and we're going to base it on direct labor hours here, total direct labor hours. So fixed overhead is going to be based on a direct labor hours. That's going to be our allocation basis. You could have different allocation bases, but just for our example, we'll look at direct labor hours. And what we're saying here is that, say, one direct labor hour will produce X amount of product here. So that's what are going to be our allocation base. So what you have to do here, there's a number of things you're going to have. In our case, our example, our actual fixed overhead rate is going to be our budgeted or some standard fixed overhead rate we have for the period. And what we're going to have to do is how we allocate this, our fixed overhead here based on direct labor hours. So again, in the case here, we're going to be looking at, we're going to have to determine a budgeted fixed overhead rate. Again, we're going to take our budgeted total fixed overhead cost we have for the period and then base it on the total budgeted direct labor hours we have for the period. You could also look at it in terms of standard hours here as well. But when we're talking about the denominator hours or this capacity level that we're going to be looking at, it's really in the denominator of our equation here for determining our fixed overhead rate here. So DH here is going to be our total budgeted direct labor hours. So if we look at it, and we really have three different choices here. Let's just say we have the theoretical amount here. That's what the plant could produce at 100%. The practical amount, that's practically, you're going to take this as a little less than a theoretical amount here, and then allocate your overhead on that, and then versus your normal amount. This is what you think the plant probably could do here on a normal basis here. So what we do here for determining that overhead rate here, that fixed overhead rate, just say for example we have $1 million here in fixed overhead for the period, and for our theoretical amount we're going to say we can produce at 110,000 direct labor hours. So that divided into the $1 million fixed overhead is going to give us a $9 per direct labor hour that we allocate our fixed overhead on. And then just the practical amount, well, we say we can only produce 100,000 direct labor based on 100,000 direct labor hours. So that division is going to give us a budgeted fixed overhead rate of $10 per hour. And then in a normal amount, let's just say we can only produce at 90,000 direct labor hours here. So that is going to give you, divided into your fixed overhead, going to give you $11 here per hour where you allocate your fixed overhead. So what you're doing here for these allocation amounts, you would take the direct labor hours you have for the period here, and then you would that you've used for the period, your actual amount of direct labor hours times whatever rate you have here, either theoretical, practical, or normal amount. And that is going to give you how you allocate your fixed overhead here. So we'll just go through and we'll track it through using this practical amount here at $10 per hour. And that is based on 100,000 direct labor hours that we have, denominator hours that they call it for the period. Okay, so let's go up and let's look at this in terms of a graph here. And I've got the graph here laid out on our x-axis. That would be our direct labor hours. That's what the overhead allocation basis. So for so many direct labor hours, we're going to allocate so much overhead here. So direct labor hours based on the direct labor hours we used here, or our denominator hours here, that times our budgeted fixed rate here. We're going to look at a budgeted fixed overhead rate here times those direct labor hours is going to give us our overhead costs for the period that we're allocating. So our overhead costs are sitting over here, and we really have two different lines that we have to deal with here. This green upward sloping line, that's how we apply our overhead based on the actual hours, or the hours that we have here for the period here. So we're really going to be looking at the actual hours that we use here for the period versus what we have, our capacity amount here, the denominator hours. Okay, so that's how we're going to apply our overhead based on the direct labor hours that the plant put out for the period here. And then the other amount that we have here is that fixed amount, that blue line, horizontal line here. So that's constant, regardless of how many hours you budgeted or used here. It's just a constant rate. And that's really just taking our budgeted fixed rate that we calculated here based on those our practical amount here times those denominator hours. So that was what? That was our budgeted fixed rate. For our practical amount was $10 per hour here times based on 100,000 hours here. Okay, so that's our fixed rate here. That would be that $1 million here. And let's just say for our problem for the period here, we only produced at 90,000 direct labor hours here. That's all we could put out, and it was based on that 100,000 here that we said we were allocating for the period. So what we would do here, based on our allocation here, we would take those actual hours, the 90,000 direct labor hours we put out times $10 per hour, and that's going to be our allocation amount here on our line here, the budgeted fixed rate times some direct labor hours here. That was $10 here times 90,000 hours. That's $900,000 here that we've actually allocating for our fixed overhead here for the period. Now remember, this line intersects here. This our applied or budgeted rate here times those direct labor hours intersects with our fixed amount here. And that's based on our capacity that we selected here, the denominator hours here, 100,000 hours. Okay, so that's what we had to allocate if our production matched our budget here. Had we produced exactly 100,000 hours here, direct labor hours, at those $10 per hour, at the fixed rate here of $10 per hour. But because we didn't here,
We actually had less. We had produced only 90,000 direct labor hours here versus our capacity that was baked on 100,000 hours here. We have what they call a production volume variance because it's below. Yeah, it's really going to be either above. It's going to the point we look at, our inflection point, that means what it means to us is this, where they intersect here, where our applied rate equals our budgeted fixed rate. That's where we would have no production volume variance. Anything less than that, we're going to have an unfavorable production variance. Anything more than that, had we produced at a higher rate here, say we had put out 110,000 hours, we'd have a favorable production volume variance because we would have produced more here. And let's look at what we're talking about. Okay, so we produced only 90,000 of the budgeted 100,000 direct labor hours. So here's our production volume variance. Again, the difference between our fixed amount that we have here versus what we have actually allocated here based on that practical amount here. So the difference is that $1 million here versus the 900,000. That 900,000 again was that 90,000 here times $10 per hour allocation rate. That difference is our production volume variance here of $100,000 right here. Difference between those two amounts here. So this is a negative or an unfavorable production volume variance because we did not produce up to the rate that we were looking at. We fell short of it here by what, 10,000 direct labor hours by $10 here per hour. So this is what we call unfavorable because we underallocated our fixed overhead here. Now, had we actually produced more here, greater than at our inflection point, then we would have a favorable production volume variance. So we would have overallocated. We would have been up here versus some point up on our green line over here that we'd actually the actual direct labor overhead that we would have allocated here. The overhead based on our direct labor would have been above. So we'd have a favorable production volume variance. And it's all based on that allocation base you use here versus what you have here in your allocated basis here times the actual hours that you've looked at for the period versus what you'd had established here as your fixed amount here. But you can see it does make a difference. Had we gone out and we used the theoretical amount where we would have the fixed overhead here would be the same. Fixed overhead, theoretical, practical, normal would be the same. The difference is how you allocate it based on that the denominator hours here. So had we had the theoretical amount, we would have been applying at $9 per hour. So our line would have been a little less steep. We still would have only put out 90,000. We had only produced 90,000 hours, so we'd have had probably a greater production volume variance would have been over here. Had we used the normal amount, we would have been our line would have been up here around $11 per hour here. So we'd have had, if you just trace out your lines, do your arithmetic, and you have to come up with either unfavorable production volume variances or favorable. Favorable is anything where you produce above the amount that you have established for your fixed amount. Unfavorable is anything below that fixed amount here. So unfavorable variance in this case, $1 million of fixed overhead that we have budgeted. We have actual for the period we're saying we've budgeted here. And what we're saying here is this actual and fixed overhead here and our budgeted amounts are the same here. Had they been different, then we'd have a little different arithmetic here. But are unfavorable because we only absorbed $900,000 worth versus the $1 million that we had to absorb for the period here. So 100,000 unfavorable. So the key is, how do you dispose of this variance is? We'll just roughly go over and understand what we're talking about with the disposal here. We really got three different alternatives. But before we do that, let's just go down here and look at, if you're looking at T accounts or balancing and you're looking at all these variances, there's many different variances, but they all follow the same rule here when you determine how you credit and debit your different variances. And what you're going to have here is, in this case, we're looking at the production volume variance. There are all kinds. There's efficiency variances and all kinds of different variances, but they all you always handle your unfavorable and your favorable amounts in the same manner here. What the favorable variances versus unfavorable. And then, so this production volume variance, that's really an asset account here. And then our cost of goods sold here is our expense account. And it's really what's flowing, those variances do affect our cost of goods sold here. Because those production volume variances are going to have to be, at the end of the period, they're going to have to be allocated in some fashion here to dispose of any variance, because we would have recorded those variances here. In the case here of this, our production volume variance, the rule is here, any unfavorable amount here gets debited here for any kind of variance. Unfavorable amounts, you always debit or increase it. And remember, this is an asset account here. Any favorable amount, that's the point where you've allocated more overhead than you've used more overhead based on your volume of production that you put out versus what you had budgeted for the period here. So this is the case. You would credit or reduce your production volume variance if there's any favorable amount here. And for where you had unfavorable amount, you debit or you increase your production volume variance. And ultimately, it would flow into, say, some cost of goods sold, some finished goods account here. And then again, same thing. You debit or you increase your cost of goods sold for any unfavorable variances here, and you would credit or reduce your cost of goods sold here for any favorable volume variances here. So that's a general rule that we follow here. And we're just looked at our production volume variance, but just remember the rule here. If you're looking at your debits and credits, you can see any unfavorable amount here, you debit or increase your cost of goods sold. Any favorable amount here, you credit or you reduce your cost of goods sold. And that's the same, that's your expense account here versus your asset account. You do the same thing. So if we go back to our graph just one more time, just to understand it. This green line here, this is actually, whatever production we put out based on our allocation basis for the period, we would go down here based on our allocation basis. We come up to our green line here, and we times it times our rate here that we're looking based on the capacity. This is all based on the capacity amount here. We had really looked at three different amounts. We could have used the theoretical amount here at $9 per hour. We use that in-between amount here at $10 per hour. Or we could have gone to the normal amount here at $11 per hour. But it does change the slope of your line here, either less or more. But what stays constant is the fixed amount that you have here for the period. So that anything below our inflection point here, where our applied rate here intersects with our fixed rate here, is unfavorable, and that would increase our cost of goods sold. That would increase in this case, our production volume variance is unfavorable. Anything in this side would be favorable here, where this would reduce our production volume variance here. And you can see why, because we would have been, our volume or our production volume would be greater here. Anything at that point, we'd have produced more here than we had budgeted for the period here. And and this side of the line, we would have produced less here than the budgeted quantities that we were looking at. So our budgeted quantities was based on 100,000 direct labor hours here. Again, times that $10 versus what we applied here and applied here. So either that inflection point is important here when you're talking about, this is where you determine your unfavorable and your favorable variances and how you allocate them based on those different rates we're looking at, and also how you handle them here when looking at our T accounts and so forth. Okay, so let's go and let's look at our disposal here of these variances, and we'll look at just roughly three different ways that we can handle it. Okay, disposal of production volume variances. So we really have three different means here. We're not going to go through the mechanics, but just understand what they are. And they do affect the variance here on operating income. And also, to some extent, we'll look at any, when you talk about operating income, you'd have to go through your flow, your cost flow here to determine exactly how these variances are handled. But they're going to be an adjustment to your cost of goods sold. They are included in your cost of goods sold. Any negative variances increases your cost of goods sold. Any positive or variances where you applied more than what you budgeted would reduce your cost of goods sold. But it's really how you would go about allocating it here. All right, so let's look at it. First here you have the adjusted allocation rate approach. This restates all the amounts in your general and subsidiary ledgers here using the actual rather than the budgeted or standard cost rate. Remember, we established our budgeted rate here for the theoretical, practical, and normal amounts here. You'd have to restate that. You'd have to put that into your system here, and it would restate it based on what you actually use here. So you wouldn't have these variances here. It would be distributed in that fashion. Okay, so the choice of the capacity level used has no effect on the financial end of the year financial statements. What you've really done is your actual costing is adopted in this case if you use the adjusted allocation rate here. Okay, approach. Now, there's the second rate type here would be your proration approach. This is where any under or over allocated overhead here is spread among the ending balances in your work in process. Their inventory accounts here is your work in process, your finished goods control account, and your cost of goods sold. So this is the case here where whatever is sitting in those different accounts, you take whatever percent is sitting in each account here, and you would multiply it times either your under or over allocated overhead here. When we talk about percent, you know, like work in process, finished goods, and cost of goods sold here, they would add up to 100%, but the work in process might be 25% of that, finished goods might be 50, and cost of goods might be 25%. So whatever that percentage is, you take it times any under or over allocated overhead, and you would adjust the ending balance in those different accounts. So again, the choice of the capacity level has no effect here on the year-end financial statements at the year-end here, because you would have taken care of all those under or over applied overheads that you had here. So that's the case here for our adjusted allocation rate approach and our proration approach. Okay, but then we get down toward the direct write-off here of cost of goods sold approach here. And the choice of the capacity level affects the amount written off using and if you're using the highest capacity allocation level here, that would have been that normal amount that we're looking at. We were charging off at $11 overhead, fixed overhead per direct labor hour. The increases what that does here, in this case, it would be increasing your ending inventory dollars here. And by deducting your deducting your ending inventory from your beginning inventory reduces your cost of goods manufactured, and it results in a lower cost of goods sold here. So it'd be vice versa here. So you really, when you're using the direct write-off method, you really have to follow through your costing here and see how it does affect your cost of goods sold. Remember, I talked about the allocation, unfavorable debit amount for the variances here, and same for cost of goods sold here. Debit amount was the unfavorable amount. You would increase your cost of goods sold. Credit amount or a favorable amount would be crediting or reducing your cost of goods sold. So the direct write-off here, cost of goods sold to the cost of goods sold, does affect the amount written off here. So again, in this case here, it does using those different rates, the theoretical, practical, and normal amount here. Choosing one of those rates here, if you go through the arithmetic on it, you will see that it will affect your cost of goods sold here, and because of their reducing your taking that ending finished goods subtracting your ending finished goods inventory from your beginning finished goods essentially here. All right, so that's roughly what we're talking about here for absorption. In this case, we looked at absorption costing for production volume variances.